morning, everyone. My name is Patrick Marcinko. I'm a financial advisor at Bogart Wealth. I'm also a certified financial planner, and we welcome you to our webinar this morning about interest rates. A lot has been happening with interest rates over the last few years. So that being said, I have the chat box open. If you'd like to ask me any questions, I'm going to try and monitor that during the presentation and get to some questions along the way. So don't hold any questions back. So with that, let's go ahead and get started. So for those of you who might be new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. And a little more background, we currently have over $2.9 billion of assets under advisement and approximately $2.7 billion of assets under management, and we work with a little over 1,300 households. Bogart Wealth is a registered investment advisor, which means we are an independent fiduciary advisor working in our clients' best interest. We custody our assets at Charles Schwab for your protection, and one of the things that I'm the most proud of is we are a fee-only wealth management firm. Bogart Wealth has advisors in both the McLean, Virginia, as well as Houston, Texas offices, and we work with clients across the country. We have a full operations and financial planning team here in our Virginia and Texas offices. And here's a little bit more of our team. We also have a group of in-house investment experts that we work with here in Virginia, but we also have a local CPA firm in Texas to help our clients with any tax preparation needs they may have. As I mentioned, Bogart Wealth, our headquarters is actually here in McLean, Virginia, where I'm sitting today. And in addition, we have two offices, one in Houston and one in Gessner. We have two in Houston, one in Gessner, and one in the Woodlands. So for those of you who work with us, you know planning is really at the heart of what we do. Now, most people that think planning for retirement is just about the investment management portion of it, and very fair thing to think. But everyone's situation, we believe, is different. And it's important for us to focus not only on your goals and manage the issues that are important to you, but look at that from a holistic standpoint. And so for those that are new to Bogart and have not gone through our financial planning process, I encourage you to reach out to your advisor or myself, and we're happy to talk a little bit more about some of the specifics as it relates to what you and your family are working towards. So with that, I want to just do a quick call out before we get started. So Bogart has a endless amount of educational content. It's one of the core pillars that we're really proud of. And so we produce a number of educational webinars throughout the year, and we invite you to join all the future webinars as well. For those webinars that we've had in the past, you can find those at our website, bogartwealth.com. But it really covers a true spectrum of different topics, whether it be retirement planning, Social Security, NUA, long-term care, mega backdoor. We try and really provide some variety there. So if you're looking for any of those webinars and are having trouble finding them, reach out to us and we're happy to get those over to you. So with that, let's get started today. And so today we're going to talk about how do discount rates affect your lump sum? Now, when we're speaking about interest rates, I want to note that this presentation today is going to be geared towards the ExxonMobil pension program. This could relate to someone who does not work at ExxonMobil, depending on what their pension options are. But it also, is going to depend on how their company manages their pensions. So just because you might not be ExxonMobil doesn't mean today's presentation isn't relevant to you. So today, we're really going to focus and try and get an idea of what interest rates are doing across the board and how they impact the various parts of the ExxonMobil pension plan. Now, specifically, we're going to talk about the qualified pension at ExxonMobil. There's probably a handful of you on the call that may have the non-qualified pieces. If you haven't heard non-qualified, this also can be referred to as the APP and the SPP. Again, this call is very relevant to you, but we will be focused the majority of today's discussion on the qualified portion. And it's important to note that the interest rates, talking today, do affect both parts of the pension. So with that, which discount rate applies to me? It's one of the questions which comes up for almost everybody here. And so it's important to remember the general rule, and that is that the rate that's in effect on your benefit commencement date, sometimes referred to as BCD, will be the one that applies to you. Now, the benefit commencement date is always the first day of the month. It doesn't matter if the first day of the month is a holiday. So for example, to get a second quarter discount rate, the absolute latest your benefit commencement date can be in June 1st, or would be June 1st. So by July, you're already in the third quarter. Now, there is an exception to that, and I don't know if any grandfather folks are in the room today or not, and we'll get back to the definition of grandfathered in a minute, but the grandfathered participants really comes from the Pension Protection Act of 2006. And so the main reason we mention this is because you may have heard of this at some point and have it in the back of your mind, this option, but this grandfathered caveats really only apply to a select group of folks. So for those that are grandfathered and meet that, we'll talk about that in a second, what that really means for you is that you have the option to choose the first available BCD, and they can choose the interest rate on the first day of retirement or the interest rate on their BCD. So breaking that down just a tad farther, what this means is that an individual would have to make their last day of employment on June 29th in this example, and this would result in their first day of retirement being June 30th. They would be able at that point to choose either the second quarter or third quarter interest rates. This, though, applies to very few people, and there are a good bit of confusion around this. All right, so let's talk about the Pension Protection Act of 2006, and it was very influential on the pension program that we have today. So, as I mentioned, the Pension Protection Act was passed in 2006, took effect in 2007, and one of the most important parts of this is that it places limits on companies who provide lump sums. For example, a pension must be 80% funded in order for them to offer a 100% lump sum option to their employees and participants. Now, if the funding levels drop, then their lump sum options can change. This has never happened to ExxonMobil, so it won't be as much of a focus for today's presentation. But some of the other things that the Pension Protection Act defines is what are the discount rates that can be used, and notably the change from Treasury rates to corporate rates. Also, we'll get into that in a little bit. Additionally, and this was a pretty big update, it requires that companies need to refresh their actuarial tables every 10 years. The last update was done in 2018, so they must make an update by 2028, though if they would like to, they can do an update sooner than that. So some items that were changed, but some of them don't affect the lump sum. All right, talking a little bit more about the grandfathered group for the Pension Protection Act of 2006. Now, like I mentioned, it's becoming more and more uncommon that folks are still covered under the grandfathered section, but just in case there are a few folks on today's call, let's talk about it. This grandfathered portion was, as I mentioned, part of the Pension Protection Act, and ExxonMobil adjusted their plan accordingly. And so what that meant is that we effectively had, if you were an individual and had been age 85 and had 15 years of service, you fell into that category. And this meant you needed to be born before 1958 and hired before 1998 with no breaks in service. It had to be continuous service. So if you're wondering, is that me? Right now, you'd have to be about 66 years old and have about 26 years of service. So it's likely not many of you will fall into this category, but if it is, and you have questions about what this means specifically, please reach out to one of your Bogart advisors. So if you are in the grandfathered category, really all this means is that you just use the 30-year Treasury bond rate in the mortality tables from 2000 rather than the updated ones we're going to go through today. So let's talk about the 30-year Treasury rates, what some of the trends have been there for the grandfathered category. So we do have a few more slides on the grandfathered pension program. And so effectively, the chart we have here shows that the long-term trend of the 30-year Treasury is headed down. And as you can see, we've been coming off historic lows and interest rates have been going up a little bit, but also rates are very far from the levels that we saw in the 80s and 90s, even despite the recently high inflation that we had in the US. So again, this chart really is only relevant for those in the grandfathered category, but for those individuals, remember, every day counts when you're looking at your segment rate. So what you effectively do is take 95% of the 30-year Treasury rates and then round them to the nearest 0.25%. Pretty simple calculation, and we'll talk about it in just a second. All right, so breaking this calculation down, this is probably going to be our last slide on the grandfathered section. But again, the biggest distinction is that every single day counts for the grandfathered folks when they're determining the interest rate used for their pension. So you can see in this slide, the discount rate is calculated from raw data. We looked at that on the last slide. And we really, all we do is take the average of those days instead of the months, take 95% of that and round to the nearest 0.25%. So pretty simple calculation. And if you have questions on that and you fall into that category, please do let us know. So now talked about the grandfathered portion, let's go ahead and talk about, at this point, the non-grandfathered rates. All right, so for those of you who are under 50 or had less than 10 years of service on December 31st, 2007, these are the plan rules that are going to apply to you. Now, most folks on today's call are going to probably fall under this category in this set of rules and stipulations. And so one of the bigger changes is that the new rates are tracked by using corporate bond rates instead of government bonds. This was a rather tough change because corporate bond rates typically have higher yields than government bonds. And as we cover in a few minutes, higher rates are not always better when it comes to your pension. So if you're really curious about this and you want to see what the current high quality corporate bond yields are, use the link on the screen here and you'll be able to see them officially posted on the IRS website. So we'll cover this in a minute, but one of the key distinctions as well is that the rates are broken down using 3 segments. Before in the grandfathered category, we were just looking at 1. Now we're going to be looking at 3 different segments, and this is a very big change as it relates to the prior rules. So we'll get into what are the 3 segments, how does that affect you. But one more key update is that companies need to use updated mortality tables. We talked about this a little bit earlier, but they need to be updated at least once every 10 years. And so this is actually a good thing because a longer life helps the pension calculation in that there are going to be more annuity payments factored in, which ultimately will increase your lump sum. All right. Let's talk a little bit about the segment rates. You can see 3 different lines here. It's a lot more complex than the grandfathered rate where you just had the one chart. So when we look at this, we want to know, okay, what are the segment rates really historically since they've been published? And so I know I mentioned this, but there are different segments that we need to know for the ExxonMobil pension plan. So segment 1, you can see that in the green there, is going to be the shorter term rates, which is 6 months to 5 years. Segment 2, that's going to be the blue there, is going to be from 5.5 to 20 years. And segment 3 is 20.5 and beyond, up to 60 years. And so as you can see, shorter term rates can be a little bit more volatile, but each segment of the rates, or of the each segment rates, uniquely affect your pension calculation different. So just because interest rates have come off their low and have definitely moved up, we still want to be looking at how does this impact your lump sum. And we're going to talk about that in detail on the next few slides. So, all right, let's look at some of the biggest things to think about as it relates to segment rates, the different segment rates. And so, all right, drilling down on this, one of the biggest things to know is that only the last 2 months in the quarter are used in the calculation for interest rates. So at Bogart, we help track this for each segment, and we compare that to the published data from our projections. But the big takeaway here is that we want to keep in mind the rates for the first month of the quarter do not give us anything more than just an indication of where rates are headed. So you can see in the table on the left here, July doesn't count, but August and September count. And so these are the ones that we're particularly focused on as it relates to your pension projection. All right, and so breaking that down a little farther. So we talked about what are the different, segment 1, segment 2, segment 3. So let's talk about the last slide in a little bit of a different manner. And actually, before I get to that, it's important to note that the annuity option is not affected by the underlying change in rates that we're discussing right here. So again, for you non-grandfathered folks, you need to know that there are 3 different groups of rates that apply to you. But when you're looking at that, it's going to be hard to see, okay, well, segment 1 did this, segment 2 did this. How do the 3 work together? Because in some cases, the rate, one segment could increase, one segment could decrease. It can be hard to distinguish what has really happened quarter over quarter. Well, at Bogart, we really help calculate that for you. And so what we're looking at is a single rate equivalent, so that you can see more easily what's the change quarter to quarter. So when we look at that, let's take an example. If you're comparing Q1 2025 actual rates to our Q2 2025 projected rates, just by looking at the 3 segments, and this would be segment 1, segment 2, segment 3, it's going to be pretty difficult to look at that and understand what the exact difference is quarter over quarter. But look at the age 55 single rate equivalent. You can see the actual Q1 rate is 4.98%, and the projected Q2 rate is a couple basis points higher. So we've helped design the single rate equivalent for folks to more easily digest and understand, okay, all 3 segments did this. Well, what does that boil down to? How does that change? And so that is what the single rate equivalent is. We're going to talk about both, but the single rate equivalent is something that really helps simplify this process. And so in the last few slides, the charts detailed the short-term moves in single rate equivalents for non-grandfathered folks. Well, we wanted to share a historical look and point out that corporate rates, very similar to the 30-year Treasury rate on an earlier slide, they're well below the highs we saw in the 80s and 90s. And during the pandemic, rates, as you can see here, they dropped to levels we haven't seen in decades. And since then, rates have moved a little bit higher. We hear a lot about rates moving higher, but it's, important to know, though, that rates are very far from the levels that we saw in the 80s and 90s. And so if you have questions, where do we think corporate bond rates are going? Where do we think segment rates are going? If you have any questions at all about these projections, a Bogart advisor is always happy to help discuss the impact on your financial plan. So let's use an example. Talked about historically where interest rates are. What are the different types of rates we use? Well, how does it actually get to an actionable item for you? And so, like I mentioned, we've discussed the interest rates, how they're used for ExxonMobil. In this example, we want to look at, okay, if you're getting ready to retire, you need to understand what are the factors that influence. So let's dig down a little bit farther. One of the things to think about when you're getting ready to retire, getting ready to elect your lump sum election, is that you do not have to elect the pension. And this is something that you would need to work with your Bogart advisor on. And let's talk about whether this makes sense for you. And so the next couple slides, we're going to do a deep dive into these lump sum calculations. And again, the interest rates do not impact the annuity value. So, all right, let's get started with this example. In this example, we want to discuss the impact, number one, of the age you take your lump sum, the life expectancy assumption, as well as the segment rates in your pension. And so you can see for this example, we're assuming a 60-year-old retiree. We're assuming that the annuity value that this 60-year-old, you can see that here on the table on the right, is about $75,000. And this is going to equate to a $1 million lump sum pension. Now, again, what are the factors that affect these numbers? First, let's talk about life expectancy. In this example, their life expectancy would be 84. So you can see the model payments run through 60 all the way through 83. And during this time, the annuity remains the same, but the segment rates change. If you look at the annuity, it's 75 all the way through. But the segment rates to the column on the right of that are a little bit different. Again, what are the three segment rates? Well, number one, segment rate one goes from the first year out for the first 5 years. Then segment rate two goes from year 6 through 20, and then segment 3 is beyond that. So you can see in this example, we're assuming that the segment 1 rate is 5.14%, the segment 2 rate is 5.34%, the segment 3 rate is 5.57%. And so you can see in this table, the 5.14 is just at the beginning. Then we have the segment 2, 5.34, and then it eventually switches over at age 80 to segment 3, 5.57. So all these factors together, between life expectancy, what the annuity estimate will be, and the segment rates, would project this 60-year-old retiree, their lump sum to be $1 million. Now, what happens if they did pretty similar fact pattern, but they want to retire younger? So in this example, different than the last one, the retiree is age 55. And so let's look at, again, how the factors affect their lump sum value. So you can see that the segment rates in this example are the exact same, 5.14, 5.34, and 5.57. And just to reiterate one more time, segment 1 is the first 5 years, segment 2 is years 6 through 20, and then segment 3 to 5.57 is really just for the remaining years after segment 2. But what changed? Well, for one, the annuity is less. The annuity in this example is now about $56,000 less. Well, why is this the case? That's a pretty big input to change. Well, we need to know that there's a reduction in the annuity payout if your pension benefit, is taken early. So there is a little bit of a haircut that applies to each year the benefit's taken prior to age 60. So you can see that we're assuming that because he's taking it 5 years early, or she's taking it 5 years early, the annuity is now 75% of it, or 75% of what it was in the prior example. Another thing, sometimes this surprises folks. Look at the life expectancy in this example. Life expectancy here is 1 year shorter, but there are actually more annuity payments in this example because we're starting the benefit that much earlier. So we're losing a year on the back end, but we're gaining almost 5 years on the front. And so you can see the change in there. But as you can see in the top right, it's no longer a $1 million annuity. There is an element of discount for those who are taking it early. For those who are taking it early, it's important to understand what is that haircut, how does that quantify for you, and if there's any questions whatsoever, your Bogart advisor is more than happy to talk with you through that and help really drill down into the nuance of your individual calculation. So, talked about the 3 different segments. I also mentioned that there is a single rate equivalent. The single rate equivalent, and I won't go too deep into this today, effectively it's the internal rate of return, or IRR, that's needed to get the same lump sum value using the 3 individual segment rates. And so I'd say that this is probably getting a little in the weeds, you could say. So if there's any questions to know about the single rate equivalent calculation, how that translates over to you, please let your Bogart advisor know. Okay, this is arguably probably one of the most popular questions. What is the impact of interest rate changes on your lump sum? So continuing with the example, the prior example that we just used, a lump sum for a 60-year-old retiree was about $1 million, and their single rate equivalent was about 5.37%. As we think about what changes in rates would do in this example, let's consider a few rules of thumb. A 1% change in rates in either direction equates to about a 10% change in a lump sum. Now, for a change in interest rates less than 1%, you can see that the change is close to linear. So when we're looking at an example, January 2025 versus December 2024, the discount rate decreases by about 46 basis points, or 0.46%. And in that time, if interest rates come down, likely the lump sum is going to go up. The lump sum did increase by 4.6%. Or in this example, for $1 million lump sum, the pension is now about $46,000 higher. So interest rates do have a very large impact on the direction of what your pension value will be. And if there's questions about this, or if there is expected changes in interest rates, it's important to talk to your advisor about how that's going to ultimately change the value of your pension. So, all right, this slide is designed to build on that 60-year-old example one more time. And you may be wondering, well, why is the top bullet crossed out in this example? Well, we wanted to really show in a simplified kind of manner how one might go about calculating the lump sum from the annuity. So you can see a shift lower in the assumed discount rates. We're going from, in segment 1, 5.14 to now 4.43. In segment 2, we're going from 5.34 to 4.86 and so on. You can see that there is a change in the present value. You can see that in the green circle. We're about 4.5% higher. But look at the annuity value. In the first example that we looked at a few slides ago, the annuity did not change from this example. It's still about $75,000. So the annuity is not impacted by interest rates, whereas the lump sum is. So lower overall interest rates typically leads to a higher lump sum. Should I retire now or delay the lump sum? Often a question that has arisen, particularly as interest rates have risen. And so a quick note, remember that delaying the pension only applies to the qualified portion. The non-qualified portion, APP, SPP, they're going to have automatic payouts. So we're staying with the qualified. Important thing to note on this though, everyone's situation is going to be completely different. And you want to talk to your advisor because there's three main things as well as a number of other factors that go into this decision. Number one is, when do you think you're going to need the money? When are you retiring? What is your cash flow strategy? What is your withdrawal strategy? Are you retiring before age 60? And as we've talked about in numerous different points today, are interest rates expected to maybe fall in the future? And so all of these factors, it could potentially make sense for you to delay. But again, that's a big decision, and I would strongly recommend talking to your Bogart advisor about that. Shifting gears a tad, when we're thinking about the decisions you need to be making for retirement, Bogart wanted to provide kind of a list of key events to be mindful of coming up. And actually, hang on, let me go to a more detailed slide than this roadmap. So attached is an example of the retirement roadmap for someone looking for a BCD date of January 1st, 2025. So typically, when we're thinking about what are the steps to retirement, you want to inform your supervisor about 90 to 120 days out. Now, this will include things like the last day on the payroll, first day of retirement, your actual BCD date. But in addition to notifying those things, you'll want to request your ITR, intent to retire package. Now, after you receive the ITR package, you're going to need to review and complete it with notarization. And at this point, you'll review the lump sum and annuity election forms. You'll review the qualified rollover form. You'll review the address verification form. And you'll also look at the non-qualified pension election form. And you must return this at least 35 days prior to your BCD date. Also, don't forget, it's important to change the medical plan payment method on the Exxon Benefits website. Have any questions about that, please let us know. So fast forward to within 1 to 2 days of your BCD, the lump sum rollover check should be delivered to you by mail. The supplemental pension, if applicable to you, is paid via payroll. And next, you'll hand deliver or send via prepaid UPS to Bogart Wealth. And you'll also want to be meeting with your Bogart advisor to review the strategy for cash flows, investments, taxes, and if there is a NUA, net unrealized appreciation plan. 5 to 10 days from after retirement, you want to meet to complete the savings plan call with Voya. This is going to include things like your Exxon NUA shares, potentially Exxon IRA shares, any after-tax money that's in the Voya savings plan, as well as any other questions as it relates to Voya. So let's look at 10 to 15 days after rollover. So at this point, the savings plan check should be received at Bogart. The savings plan IRA, ExxonMobil shares received should also be with Bogart. And then the NUA statement should be received and emailed to Bogart. If you have questions about this process, please let us know. We're happy to help with any part of this, so please do let us know. All right, what are some strategies to consider now when planning for retirement? Well, number one, if you don't have a plan, make sure you get one. It can be helpful to develop a plan to alleviate any uncertainty as you transition to retirement. If you don't have a plan, Bogart Wealth would love to help you create one. So one of the most underrated planning items for retirement is having a budget, shifting to the next gear here. And it might not be the most fun exercise, making a budget, but it's so important that you have a gauge on, helping, what will spending be in retirement, as well as being able to monitor spending throughout retirement. And the budget really will help with a lot of your financial planning throughout all of retirement. So a budget's a often overlooked one and very key. And lastly, it's really important to help understand your long-term risk profile. And that's going to help you understand which pension option is best for you. So questions about that, please talk to your advisor. So want to conclude with the portion of the presentation about interest rates. If you don't have a financial plan, there's never a bad time to take the steps to get one. At Bogart Wealth, we're happy to meet with you to learn a little bit more about your situation and determine how we might be able to help. So if you're looking for a financial advisor, here are some of the things that you definitely want to know. What's their experience? Are they a certified financial planner? Is it a financial advisor who knows your retirement plan, knows the IRS rules, and can really be an expert on different business cycles as well as financial planning techniques? They also need to be open. They need to be able to discuss various strategies with you and your family. They also need to be, communicating in a way that you can understand. So just some things that, when you're looking for an advisor, you may want to consider. And like I mentioned, we do offer one-on-one financial strategy sessions. So if you're interested in this, please reach out to our team. With any questions, feel free to contact us. Toll-free number is 800-377-3465. As I mentioned before, we have offices in Virginia as well as the Houston, Texas area. And with that, I want to thank you all for joining today's webinar on interest rates. For anybody who has an interest in some of our future content, we have podcasts now. Follow us, Facebook, LinkedIn, Instagram, YouTube. And with that, I want to thank you all for your time, and we'll talk to you soon.